Welcome, I'm Amanda Morrell for Edison Group Television, and I'm joined today by Grant Webster, who's the Chief Executive Officer of Tourism Holdings in New Zealand. Welcome, Grant.
Thank you.
So to start off, can you just give us a little overview of your business and your product offering?
Yeah, so we're a tourism company, as in the name. Our main product that we have is recreational vehicles, or motorhomes and camper vans. We operate those here in New Zealand, in Australia and in the US. We're the largest operator of rental motorhomes in the world. We also obviously sell those as well in all those countries. In addition to that, we've got other tourism products in New Zealand. We've got the famous Waitomo Glowworm Caves. Mm-hmm. We've got Kiwi Experience Youth Hop-on, Hop-off bus network as well. And we have a manufacturing joint venture on the side as well, which manufactures motorhomes in New Zealand.
And how long have you been in business?
We've been public listed for about 28 years now.
Oh, a long time.
So yeah,
okay.
Been around a while.
Yeah, excellent. So I understand that the 2015 early results just came out, or interim results. Can you shed some light on those?
Yeah, so a really positive result and well received. So net profit after tax was 5.6 million, up 100% on last year. We're on track for our year-end forecast of above 17 million net profit after tax, which is up from 11 last year. Debt was down about 10 million on last year. Dividends have increased from 5 cents to 7 cents. So overall, a very, very good result.
Excellent. And what's driving all this good news?
Yeah, so we've been changing a lot of what we do internally. We've been focusing on return on funds employed, reducing a lot of costs, aligning fleet to the market in the right places. And on the background of that, it's a good positive tourism environment around the world today as well.
Yeah. The board is now focused on restoring and maintaining returns on funds employed at acceptable levels across all divisions of the company. So what are you doing to achieve that?
Yeah, so look, we're keenly focused on this point. So we've been a bit of a perennial underperformer in times of world volatility, so certainly around the GFC. The key drivers for us, first and foremost, was getting our fleet alignment right, getting our debt down in the right places, and that's been very well controlled. Beyond that, it's actually changing our business model, making it far more flexible, dealing with the operating leverage in the business, reducing our fixed cost structure, and changing by country a few little elements that were needed to really bring that restoration to life. US is fine. US is fantastic return on funds. Our tourism businesses also have a superb return on funds, both well over 20% or 24, 25. It's the rentals businesses in New Zealand and Australia that we're working on the most.
So how many companies or how many countries do you have a presence in?
Yeah, so we're operating in 3 different countries. Yeah. We've got obviously our core customer bases from all around the world. Europe, Germanic Europe is very strong, the UK is very strong, so we've got sales offices up there as well.
And so can you provide any examples of your selling and experience and moving with that light capital investment strategy? Yeah,
so look, in terms of experiences, so what we've keenly focused on is saying engaging with the customer more is really where the world's heading. It's all about local, it's all about that depth of engagement. And to be fair, traditionally we've probably been, here's your motorhome, it's a great motorhome, you're in a fantastic country, have a good time, and bring it back safe. And so we're really trying to increase that level of engagement, what we can offer people, what services we can offer people when they're on the road, just keep that level of engagement. And from that, over time, we see there's real revenue opportunities.
Okay.
In terms of the second part of the question, which was the capital employment. So the key thing for us there, every time you put a motorhome on the road in New Zealand and Australia, it's well in excess of $100,000. They're big, expensive vehicles. And they're not that easy to sell. So we need to look at ways that we can reduce that capital exposure, look at growth in areas that have more flexibility in that model. The US is a prime example for us. We basically, in the last couple of years, have rotated 100% of our fleet in a 12 to 14 month period. So anything's going to happen from a big world event, we've got that flexibility in that business model, and we're starting to build that flexibility into the same models in Australia and New Zealand. Rest of the growth strategies for us have to take that into account, without a doubt.
I imagine that the biggest segment of your market is probably baby boomers, and it would only look good for you with people heading into retirement, or barreling into retirement.
Yeah. Both on a rental front and on a vehicle sales front, because it's along with that baby boomer growth, there's also a growth in experience seekers, basically. So people aren't satisfied just sitting in a coach and watching the scenery as they go by. They want to be part of it. They want to partake. They want to park somewhere different. They want to stay somewhere different. And our product is all about that. So not only is it the baby boomers, but it's those experience seekers as well. So it's growth for us, without a doubt.
In terms of getting back to the New Zealand recreational market, it is the most capital intensive for you, but it is the poorest returner of funds. What are you doing to recalibrate?
Yeah. So there's been an industry-wide issue post the GFC in New Zealand where there was excess capacity in the market, considerably so. We sort of thought it might have been around 10%, but it ended up that we proved it was around 25%. So we did go through a classic industry consolidation. We purchased two of our largest competitors, and that provided us with the opportunity to right-size the whole industry and market, reduce costs, clearly, create those synergies that exist when you have that kind of merger, which we've delivered on every single one of those, and re-look at how we actually shape that business in terms of how it actually operates and the structures behind it. In addition to that, those competitors went into receivership as well, and the industry has, I think, just realigned itself considerably. I would call it structural change. It's a much smarter industry in New Zealand now, much more aware of that need to stay away from fixed capital.
Okay, very good. You've mentioned that you won't expect satisfactory returns until next financial year. How do you categorize or quantify the satisfactory return? How are you tracking towards that?
Yeah, so we measure that around the 14% return on funds employed, and that's EBIT. We use that as EBIT over gross funds. And that is a good proxy internally for a WACC return for our business. So the key for us is making sure that fleet is at the right level for demand in the market environment, and we've been shrinking our fleet in New Zealand over the last couple of years to make that right. That obviously brings down costs as well. It gives us the opportunity to focus on greater revenue per vehicle and realign the cost structures accordingly. So we are definitely a leaner operation than what we were. We're a smarter operation than what we were, and we've got those other synergies. So we're well on track. The proof points along the way, because it is a bit of a process, are all on track as well. So we're confident about that FY16 number. Okay, good.
And with respect to the debt you're carrying, and I understand that's about 80 million New Zealand dollars. How's that impacting dividends? Is there...
more dividends. Shareholders are happy. So I guess for us, we have reduced debt from the merger point where we acquired the other operators in New Zealand was about 150 million of debt. We're down to the 80 odd mark. Delivered on all the expectations there. Dividends have been increasing through that time as well, along with profit obviously. We've just announced the 7 cents that I mentioned before. So for us, we don't have a clear dividend policy out to the market at this point in time because we have been in that recovery mode. We have been growing dividends. We certainly see the potential for that. And we don't want to be lazy with our capital allocation internally, but we also want to be clear to the market that we're talking growth. We want to focus on growth. So there's going to be that balance. So we don't see dividends going backwards at all. We still want to target dividend growth, but looking for those growth opportunities in general for the business at the same time. I know that's a fluffy answer. I know that's hedging my bets, but that's the reality of where we are.
Okay, well, we'll leave it on that note. Grant Webster, thank you very much for joining us. I'm Amanda Morrell for Edison TV Group. If you would like to hop online and learn more about Tourism Holdings, please visit www.edisongroup.com, and we'll see you again next time.